earnings model to determine the value of each company's stocks and then compare it to the actual price and then evaluate our findings. Well, the goal of this project is to explain the kind of steps we use to formulate the estimate of the value of the stock, each company's assumptions we use to determine the value of the stock, compare the actual to computed price of the stock, and if there's any difference, and kind of an opinion of why we think there might be a difference, and also dive a little bit more into a sensitivity analysis as to why, change things in the assumptions to understand better why what we accounted for differently to make the stocks more comparable. So first we're going to look at the tools and steps we use, the tool being Exhibit 6.9, and the steps kind of go through what we did with Exhibit 6.9 to come up with our estimated price. As each company's the same kind of steps, we're just going to kind of go through this, and I'll start with MPC, and we'll just kind of show where the information is entered and the outcomes, and then we'll dive into each company individually. So first we focused on, we read through the 10K report, and then we focused on the statement of change in shareholder equity. We focused on the past 4-year ending balances of the total shareholder equity, comprehensive income, dividends, and stock issued, and then we had an aggregate category of other, which you'll see right here. This is where we entered them all, the information entered. Once we found the balances, we entered them here, and then what that did was it calculated, and the other category kind of made everything, encompassed everything else to make sure we could split the difference between them. We then also looked at the consolidated balance sheet, and what this allowed us to do was we put the current amount of stocks in here. What this allowed us to do, though, however, was it was able to come up with a beginning book value. So if you take the stocks, you divide it by the shareholders' equity. This is kind of our beginning book value of this whole project. Then the information kind of translates over into this is the value of the stock, how income growth and dividends and shares affected the book value of the stock, and it goes on and so on throughout the years. And based off the information provided, we're saying that at the end of the most recent financial statement, that this is saying that the value of the stock should be $20.78. Now, if you move on to Exhibit 9, Exhibit 6.9, you can find here the current equity book value of the stock is 20.78, and that's where this will play a role for our hypothetical estimated price later. Sorry, I keep clicking off the cells. I don't want to damage the math. Then we went to the assumptions, which this is wrong. I apologize. What we're going to show here is that we then looked at what we thought the earnings per share would be over the next 5 years, abnormal earnings, discount rate, forecasted stock issued, dividends, and other things. This is kind of what we think the future tells. This is what we want to, this is our assumption of what this company is going to do. And this greatly affects, as you can see on 6.9, what we're evaluating the stock at. Because when you value a stock, you have to look at the future. It's not just what it's worth today. So we'll start with, now we'll kind of move on individually to MPC. And it's like, I know that was a pretty fast overview, but as we go through each one of these companies, you'll really see the steps that I took. So we'll start with Marathon. As you know, we entered in all the information as we previously seen from the consolidated balance sheet and the statement of changes in shareholder equity. And we saw that $20.78 should be the current value of the stock based off these numbers, or book value of the stock. Then we made our assumptions. I factored in a growth rate of 7, earning per share of 7. This came directly from Yahoo Finance. As you can see right here, this is a wonderful tool for using analyst opinions for where they think this stock is going to grow. 7.43. You can see 7 right here is what they're saying over the next 5 years. I thought that was a good place to start. Also, as if you look right here, I took the average growth over the past 3 years. It was 7.16. I thought that was a great place to start. We then went to the abnormal earnings forecast. We did 3.25 saying that that's about the gross domestic product average. And what we wanted to do there was you don't want to go too high, because if you do that, you're saying that you grow better than the average and you rule the world. Then we went to the discount rate of 10.81. As you can see right here, this is the formula that we use utilizing the beta, the risk factor, and the market return. The beta comes directly from Yahoo Finance as well. You can see 1.43. Then we use the interest rates, saying that federal funds right now is a 0.13, so that was the number we used there. The historical returns at around a 7.6. So that's where we number. And this number will be the same for East Group Properties, just a different beta. So we'll go back to our spreadsheet. So then we also did stock issue, dividends, and other things. And what we did there was I took the average of every year, and then I came with of every year in each category and came up with an average and put them in there in the assumptions in the appropriate tab. So what we did was now, though, is we went to Exhibit 6.9. It says that, hey, we're saying it should be 77.06. They're saying it should be 56.96. $56.96. Okay. Well, we got to do a sensitivity analysis, and that'll determine why we think there's a difference. So what we'll start with is the discount rate. I found that if you go up to a 13.5%, that will change. That will get you roughly pretty close to it. So we'll use that as the number for now. But I think a 13.5% discount rate is pretty high. I mean, that's a pretty high expected return from your investors. But to make the math work right now, that's where we need to be. We then looked at earnings per share. So I found that at minus 11%, which we know that will never. Now, we're not saying that companies can't have bad years, but looking at the next 5 years, with these two staying the same, abnormal earnings and discount rate, I mean, we're showing, well, it's a little bit lower, but you get the gist. Negative 11. That gets us closer. We'll go negative 9. I mean, it's getting us closer. It's just showing that a negative balance essentially will get us to where will bring us down to where we need to be with the current discount rate and abnormal earnings. There you go, minus 5%. So what we'll do from there. So let's get that set back at 7. And then we'll look at the abnormals earnings. We'll change that to a negative 4. And what that shows us is, boom, we're right there, right at about the same price. And we know that the world is not going to, I mean, you can't go in business with a gross of minus 4. That's not a viable option. So we'll move forward from there, and we'll take it back to normal. The normal 3.25. That number needs to stay the same. Oh, whoops. What I then found was that if we went for a 5 here, and then a 13.5 here, we about nailed it on the head. So I think what I'm going to say here is that we bring down the 5% more to a realistic growth rate, a safe growth rate, and then we increase the discount rate. And maybe what they're looking at is 5% is a safe return, good and bad years, and that, you know, that with it being a riskier business, investors expect a higher yield or return discount rate. So therefore they're evaluating their stock at a 13.5. That way to bring the value of the stock down. So that's pretty close. What we'll go next is we'll go into East Property Group. Again, we did changes of equity, got all the information here, and then we came out to say that we had a value of the stock of 17.86. That translate right there. We did the assumptions, similar thing. 5.3 came from beta. 5.3 came from Yahoo Finance, 3.25 using the same GDP. 7.3, very similar Yahoo Finance, except the beta, everything else stays the same, but the beta came from a 0.96, a little less riskier. 7.3, which is actually pretty similar to a market return of 7.6. Then we did 2.5, and then these numbers again came from our averages. So what that shows us is that our shares are 1472. Now again, we'll go to a sensitivity analysis. What I found is that we can go to a 4.55% discount rate. So 4.55, and that would get us pretty close, pretty close. We'll go back to 7.3. Really, you could have probably stopped the analysis right there, but just to kind of go through what, you know, how drastically these would need to change. We'll just kind of go through -25. I'm not going to go into the the abnormal earnings. We're going to keep that there because that just kind of has to be what it is, because you're not going to change value too much. So there you go. I don't know what happened there, but what happened there again, this is not going from what I originally saw. So I apologize. Well, originally I computed my math at 25%, and that did not get it where we wanted to be. But based off his history, what I'm going to do is I'm going to go back to where we originally started, because this 5.3 came from forecasted earnings from Yahoo for EGP. So what we're going to do, we're going to say we're going to keep that, and then we're going to change our discount rate back to 4.55%. And what that's going to tell me is that I think the expected return, maybe as it's a safer investment for the future, is 4.55%. Is kind of the discount rate that they're going through for. And I would think that with 5.3% being the average growth that's expected over time, that this might not be too far off. But when I computed my math earlier, the assumptions, we had to go to a very negative number here in the earnings per share to really get that number up to where we wanted it. So, or actually, I know what it was, and I apologize. 25% increase to get it there, and we know that is not viable. So again, I think with the 5.3 that this would be why we could say that there's a good number, and that bringing this down to a 4.55 discount rate would get us where we want to be, and maybe that's where they're evaluating their stock, is that at a 4.55 discount rate, not a high of a return as a return. Also too. Okay, well, that's kind of my analysis on both companies. I hope that explained everything pretty well, and this information will accompany the paper. Thank you.